Some people just concentrate on trading patterns in the market. Let me see. Okay, some people just concentrate on trading patterns in the market. That's all they trade. And by patterns, I mean head and shoulders, double bottom, ascending triangle, the cup of cocoa, like we call it. Well, it's called the cup and handle, what we call the cup of cocoa. Some people just trade that. All they look for in the market are these patterns. They don't do any other thing. And once they see it, you just either they are selling or they are buying. But like every other strategy in the market, they do not hold 100% of the time, every time. So you have to constantly confirm your trade before you jump in. You can't just jump into a trade for the mere fact of just seeing it. Okay, because I see a head and shoulder. Okay, I'm just going to jump in. No, you need to have your confirmation in place, and even at that, you still have to protect yourself in terms of using proper risk management. The strategy that we'll use in here, I can guarantee you works for me, and I know most of you guys have been saying it as well, that it works 100% for you, not just jumping in with a standard lot size. It works to just start little, start small, then increase, because that gives you rest of mind. You're not unnecessarily what's it called now, under tension. You're not necessarily constantly looking at your charts, sweating and all of that. When you have 0.0 lot size in your position, you see how much rest you can have. You can sleep for 2 days and not, feel, any kind of tension. But if you have a standard, on your trade, it gives you a lot of headache, because you're constantly thinking, is it going to turn against me? Even though that analysis was a good one, was a winning analysis. So now, what did I mean by patterns? Let me see if I can take you to the library again, so I can show you the different patterns that we have. They are very helpful. They are very, very helpful to use when getting into the market. Again, there are different strategies that you can use to trade the market, a whole lot of them. Trading patterns is one of them. So look at it. I call this particular one, the first one here, I call every one of them, the ones that look like this, I call them flags. This one, call them flags, because they're pretty much doing the same thing. It's rallying, doing a pullback and continuing. The same thing here, rally, a pullback, continuation, rally, pullback or consolidation, then a continuation. The same thing happens here, but they have their individual names. So what this is pretty much just saying that there's a rally here, which is the pole, and then there's a pullback, which is called the flag, and then it jumps to the top. How do we trade it? There's a particular strategy that we use to trade this kind of setup. This is a particular kind of setup strategy. How do we trade it? When we see it in the market, we don't just jump in. We need to wait for confirmation. Now, mind you, like I said, it doesn't always work 100% of the time. Nothing in Forex works out 100% of the time. The only thing that is guaranteed is your own proper risk management that is put in place. Knowing where you want to get in, knowing where you want to get out. Okay, so if I was to trade that pattern, that flag, let me see if I can look for one in the market. I'm just going to look for take fresh sheet. Go to the higher time frame.
One of the flag. Oh, okay, you're on Great Britain. I was going to say this one setting up on eShelf flag.
Okay, eShelf. Okay, let me look at that then. Okay, is it on the daily time frame, or what time frame is it on?
1 hour, 4 hour.
Okay. Okay, this is an example of, this is it on the downside. This is an example of what is called a flag. Why do we see this as a flag? Because there is a pole. Yep, there's a pole here. Now, the psychology behind the flag is just pretty much working with the trend line. just pretty much working with the trend line. For instance, if I were to go down, you will see how what this would mean. This is just what this is about. You do this, you put this up like this. You're using your trend line to capture all of the weeks of this move, and then when it breaks out of this, what's it called now, this trend line, it's an indication to either you're buying, if you're the scalping type, so you're buying this market, and then when it gets to a particular level as based on structure, you sell again. It's in consolidation state, because I know some people trade consolidation, you know on the higher time frame. But if you're the 1 minute, 5 minute person, you can actually trade a flag on, because what you're simply doing, you're simply just trading consolidation. That's what you're doing. Once you see a break out of this trend line, a break out of this move to the upside, then you have to start buying. Then when it gets to the top, you sell. Gets to the bottom, you buy. Gets to the top, you sell, till it breaks out of that consolidation. So, but that's not what we're doing today. So I'm just going to take you back. So if we were trading a flag, this is just what we do. It's really, really straightforward. You have your pole created, then you have your trend line created just to capture. The reason why you draw that trend line is just to box up the movement. We know that it's consolidating, it's hitting highs, it's the higher part of that trend line is getting to a particular level and not breaking it, coming down to a particular level and not breaking it. Those levels are what you want to capture in the market. So in another word, you're boxing them up, you're putting them in one box. So if it breaks out of that box, it's an indication of for you to either buy or sell, depending on where it breaks out of. Now, we expect flags to always form, to break out and go as a continuation. For instance, if it does this, we will always expect this to go back down. It comes from the top, forms a consolidation or a flag, then goes to the downside. But there's something we know in the market. Market doesn't always respect a particular move, particular direction, doesn't move in one direction. It can drop, then have a base and then rally. One thing it does, then it can drop, have a base, and then drop again. It can rally, have a base. It's another strategy if you're trying to trade the market. So these are the things that you look out for. Then drop again. It can rally, have a base. So every time it consolidates, it's called a base, and then continues to rally. So you see, for some of you that have done a little bit of this study, you see it in the market. You see D, B, D, DBD. You see DBD, D, B, R, C, R, B, D. You understand what I mean? So you see a drop. Let me put that in a larger. So you see drop, base, drop. You see drop, base, rally, rally, base, drop. So you see things like this. Some of you that have done a little bit of this research on price movement. So you see things like this in the market. You can do it if you haven't done it. Just have that. Just do a little bit of research to see what that means. So this may happen, and normally when this happens, we're always moving. That's why we have levels. It will always move to the next level. We always expect to TP at the next level. Where is it at this point in time? Where is it going to? So that's why we create levels. And how we create our levels, support our resistance. We have to always go to a higher time frame to pick the key places that price has been to or price may go to, just to be able to give ourselves areas of TP, just in case price returns to those levels or those areas or those zones, depending on what we're working with, either support and resistance or demand and supply. So this is me just simply putting this together. I'm not really paying much attention to it. So H4. You know how I roll. I don't really do 10 pips, 20 pips. Let me take out this. It's getting in the way. I don't do 10 to 20 pips. I'm always looking for maybe 100, 150 pips. That's what I'm looking for in the market. So see that move here. Yeah, something around here. So yeah, so what am I expecting? I'm expecting this to drop to somewhere around here if all things remain equal. Now, one of the ways you can find your TP is to measure this move. By measurement, we expect, okay, maybe to be safe, I could just do this. This would be my TP. Measured from here, then I'll put it here. So my TP will be around this area. So if I go down, I might find something around here, even as TP. See, because price came in, reacted here. Let me see any other place. If you go in the past, you will see a lot of reaction around this area as well. There will always be reactions. Let me change this color. So you see, oh, excuse me. So I was really expecting Oluwole to join us, but unfortunately, it's not available today. I'm not sure why. Okay, so this has been in a consistent downtrend, I would presume, because it's gone far away. It's not seeing anything. But anyway, safe side is always to pick your TP within the nearest zone. It's been in an uptrend in a long time. That's why it's difficult to see history. But if I do it, take it down like this, I may be able to see some things. Well, price has really gone. Okay, I think it was probably because of this giant move. Did you see that? It's crazy. So what price was simply trying to do here was just to correct that giant drop. That's something else to also bear in mind. When price does this, there's always a correction. Look at what it did. It did this, and then it corrected. This became a move, then this correction. So that's something else to also bear in mind. So yeah, that's how I would trade that flag if everything remains equal. If it breaks out here, I would probably TP here before even looking for another area. But if it doesn't break out to the downside, if it breaks out to the upside, there's no crime. There's nothing stopping me from, looking for closer levels before the main level. Remember what levels are. They are TP areas for you, and they are also your levels areas where you add more positions. You should find a clean name for that, where you compound. So if you started somewhere around here, if you already were in the market and you started with a 0.1 lot size, so at every key levels, most especially when you bring it down to the 15 minutes time frame, this can give you some smaller levels where you jump into the market, early enough, so you can take it to the main target that you identified in the higher time frame. So if I was to enter this trade, this is what I would do. How do I take this trade? I would only take this trade when I get a confirmation. And what is my confirmation? Now, you can either enter this trade two ways. One of the ways is when you see a breakout of this trade. See a breakout of this trade, and that breakout closes above or closes below us, because this is on a downtrend. Now, if it closes below this trend line, the highest, so it could be. So what I'm looking for me to be able to take this trade, to confirm that this trade is going to be a winning trade, I need to see. Excuse me. I need to see this a candle break and close below this trend line. Why? Because there's not been any candle that's broken it. So for that candle to break, it means it's giving me a cue to sell the market. That is an aggressive entry if you enter at a close of a candle below that and that trend line. That is an aggressive entry. So a more conservative entry would be to wait until you see another candle form, and that candle must form above that trend line before you can take your position. Before you can take a position, then you can take a position and probably enter the market at this point. When it breaks, then your stop loss can be in two places. The first place that we that we try to encourage is at the bottom of the flag, which is pretty much the previous low or previous high of that move. Previous high would be where the consolidation stopped anyway, see? Or the next place you can put your TP would be the pole of the flag. That's quite wide anyway. But if you're really interested, if you really see that move, this particular move that's happening is going to go far, if you know that it's definitely going to go really far, so you can put your TP somewhere around there. But I wouldn't, your stop loss somewhere around there. I would say it's too much anyway. But some people say you should put it here. But if you have a 0.01 lot size, it's okay to put it there because the drawdown will not be too wide. Let me see how many pips that would be. About 21 pips, not so bad. So if you are supposed to trade this and your TP would be something like 50 something, it's not a bad trade. 1 to 2. I know how we trade. A trade should be at least 1 to 2. 1 to 1, not too bad, but never trade unless you're scalping. Never have a risk to reward of 3 to 1, meaning you're risking 3 just to win 1. That's too massive. You want to risk less to win more. Unless you're scalping, you just want to jump in and jump out of the market. So this is how we trade it. Ensure that there's a break. Number one, first of all, you ensure that there is a break of that trend line. And the next thing is that break has to close below it. It has to close, that candle has to close below that trend line. The same thing happens if you were trading it to the upside. Ensure that there is a break to the upside and that candle has to close above it. Now, something might happen and instead of that candle stopping, it just keeps going. It's all good. Just let it go. Don't chase the market. Let it go because something can happen. It could wick like this. It could just throw a wick and then come back in. And then you've lost it, So unless, of course, you saw that happening and you were the aggressive trader, you jumped in at this point and your TP was somewhere around here, then you won it. You got lucky, But if you see this move happening, don't chase the market. Just let it go. If you miss that, if it didn't set up, give you a confirmation. There's no point entering the market. You always have to get a confirmation before taking a trade. Remember, like Adrian mentioned earlier, it's your money, it's your hard-earned money. You don't want to just throw it away. Get a good confirmation before you take the trade. So that is how I would take this trade. Confirmation, meaning that this next candle has to form. Then I jump in the trade, and my TP would be the pole of the level of that pole. Now, let's say I had something like this. Had the flag that looked something like this, or call it a consolidation that looked something like this, So I'm waiting for, and I have then identified, I'm waiting for a breakout. My first TP may not necessarily be the pole here. It would be the top of that move. So if it breaks out of here, because if you notice the TP the pole may be longer than maybe as this long, So my TP may be the foot of this, what's it called now? This intersection between the pole and the flag. So if you have this steep flag move, this is a very flaggy flag. If you understand what I mean, as the pole and then the body of the flag. But this one, you have the pullback. It's it went further than we expected. It was more like a pullback than a consolidation, as this indicates. So we would take our first target at the the intersection between the pole and the pullback. Yep, that will be our TP. Then we can now enter the next position to take it to the next target. So that's how you trade flag patterns. The same thing. If you let's just see if I can find more in the if we can back test it. Let's see. Some ones are not really giving good because it's been in a wild uptrend. So let me see. Let me see if I can use any one of this. Yep. So some like this is a good one as well. That's one of those steep flags I was talking about earlier. You see how this pulled way down here. So my first TP would be here. First TP will be there. My next TP will be somewhere, either the pole or remember what we said. That's why you can't just use one strategy. You need to use it use multiple strategies. You need to always incorporate your structure into your trading levels. Identify your key support and resistance areas, and then those can serve as your TP locations or your stop loss locations. Like now, if I was to trade this, I would TP at the next wherever it gave me. Okay, probably this would have been my TP. Probably I've identified this. So maybe, who knows, probably will have had to identify here. Okay, somewhere around here. Yeah, it didn't really get there, but there's no crime in jumping out if you see a trade and it's going south of where, if you entered here and you have you've been winning. I don't see any reason why you'll still be in the trade and let it come all the way back to your entry. Remember the rule. I always say it. Once you're in a trade and you're in 10 pips, 20 pips, just move your stop loss in profit. Because the goal of every trade we take is to always win it. The goal of every time we enter a position is to win that position. We should never take a loss. So if it moves, if we're fortunate, we do our analysis, we are up 10 pips, move it 1 pip. So if it comes back to your position, it means that either you enter too early or the market is deciding to go crazy. So you don't want to be caught on the wrong side. Just take it and wait for it to form another good entry, and then enter again. You don't want to get in and then your analysis was wrong, and because you felt it was right and you want to hold on to it and you're going into negative 100 and 200 and you're still holding on to it. So if you enter the market and it comes back 100%, it should come back to take you out of the market, either 1 pip in profit or 2 pip in profit, not negative at all. Yep. So that's how I trade. I make sure I do not lose any trade. So that's why before I take a trade, I ensure that I get good confirmation before I jump in. So if I was in this trade, I was going, this was my TP, and I got to this level, I have another position. I got to this level, I have another position. I'm waiting for this TP to happen. It didn't happen. By the time the market comes back, it will have taken me out of here, and all of this would have been my profit. All of this, I probably would lost this last one I entered at, but it's fine. I would have taken the other ones that I have secured. So yeah, that is that. Let me see if I can find another one in the markets. Yeah, this is quite choppy. This is another example. See that move, see that pull back, and then see that rally. This was a massive one. It created another rally, created another pullback, and then what did you see? Another jump to the upside. This was a key consolidation because it really stayed here for a while. Yeah, stayed here for a while, and then it jumped up. Now you can see what I meant by it jumping up without even giving you an opportunity to go in. Now sometimes, if you bring this down to the lower time frame, you would get an opportunity to jump in, because this would have probably just created more levels, more candles Let me see if I would locate it. Let me just put this line here. Oops, not this one. So this would have created more candles. Okay, so let's go to the smaller time frame. Let's see what's available. Okay, so see, reduced to this one, created that. If I go to the 15-minute, let's see if I have more opportunity. Where is it now? Okay. Okay, so it close, it break out, you see close above, and I entered on the next candle. Look at that. I entered on this candle. See, it's a massive win. 100 plus pips. That's 102 pips. So waiting to just see this close above and then entered on this candle. This is my move right there. And I entered, I didn't jump in with a standard. I waited and probably 0.05 or something, 0.02. It went up, pulled back. I entered again. See another flag form at this point. You know, so you see the flags can actually form on the smaller time frame and the bigger time frame as well. But it's more accurate when you're trading the larger time frame. You know, like you want to form your positions, your targets and all of that, stop loss and everything in your higher time frame, but you want to look for your entries in your lower time frame, like the 15 minutes time frame. So that would have been a winner. Then I would have protected my profit and not allow it to jump back. Now, if you look here now, see what's happening again. It's turning back and creating flags also. So the ideology behind the flag is just what it is. Markets doesn't move in one direction. It goes up and down. So that's why you see all these movements. You see pullbacks. Market would do that. You see the flag has filled there. Another one has started. You know, pullback. Okay, this didn't work well. Unless, of course, you stayed so long. See, that would have been a win. Been a win if you stayed for that long. Still a win because it went up, broke a break and close above. Now, another thing is this: it doesn't necessarily have to be a green candle for you to buy it. You know, yes, that's the rule. You could do it with a red candle as well, as long as there's a break and close above. But again, not that it's going to always work for you 100% of the time. So what do? You put your stop loss in place just in case, because it can fail. Even though it was a green candle that you had here, it can fail as well. You know, so that's why you have your stop loss in place to protect you. So it doesn't always have to be a green candle. But anyway, if you wanted to trade it, this would have been a better entry, because there's a close above and then this would have been your entry. But if you wanted to just make sure you get a good confirmation, you waited and then enter here, and then that's your move right there. So okay, so yeah, more flags. Yep, it has a pull. It's a pullback, and then that's drop, another pullback. So you definitely see things like this in the market: drop, pullback, drop, pullback, drop, pullback. So we're always trading those drops. We never trade pullbacks. We try, let me not say never, because sometimes you can find opportunities to trade pullbacks, but we try not to trade pullbacks because we do not know how far it will go. So we always wait for these pullbacks to finish before we enter the market. We wait for these pullbacks to finish before we enter the market. We don't jump on this pullback. If we were selling, we don't say, okay, it started buying, so I jump in. No, find out what's the overall direction of trend of the market. What's the trend? What's the overall direction? Is it in the bearish situation? Is it a bearish market? Then you don't have any business buying it unless you're scalping. You're just jumping in and jumping out. Yep. So that's how you trade that one. The next thing you trade is probably, I'm just going to identify two because of time. they're pretty much the same thing. What you saw on this upside is the same thing you would see on the downside as well. Yeah, okay. I think the first one we looked at was the bearish one. That drop, the pullback, and the drop continued drop. Sorry, a drop, a pullback, continued drop. The same thing happened here. Now, I must tell you that this is just the theory part of it. The way you can really, this can really benefit you is when you backtest. If you go into the market itself and look for it and try to identify how it formed, what were your, how many pips did it win you, when you backtest, and how do you backtest? Just go into the past. It's happened in the past. Find out in different pairs how your flags formed in each and every one of them, and how many pips did they give you, and how do you find the pips? By considering your support and resistance lines, or using the pole of that flag to find out if it really played out well for you. Yep. So the other one I'm going to look at is just going to look at double bottoms. I'm going to write double bottoms or double tops. Then we'll do it and show that another time. So double tops, double bottoms. Let me go to the higher time frames here. Always more pronounced in those ones. So this is an example. Now, I know I don't know if I share this rule with everyone. For double tops, normally the rule for double top is supposed to be like this. This is how we trade double tops normally. Double bottoms, or double tops even, because they're the same thing, it's just the opposite direction. Your second leg must never be lower than this first leg. So if you're trading this, the original rule says that this must never be like this. Even though this looks perfect, for you to be obeying the rule of double top, or double bottom, this must not be like this. The accurate thing to look for is this. This is what to really look for. So this must always be the predominant leg. So meaning you can have it like this, and it will still be valid. But on opposite like this. But if you look at this was a winner, wasn't it? Because you had that and you had that. I think I learned that rule from the Naked Forex book that so it was still a winner, but it broke the rule. So that's why I tell you sometimes these things don't work 100% of the time. But the only way to make sure that you win at it is to protect yourself. This is the normal rule for head and shoulder. For double tops and double bottoms. The left must always be, must never be taken out by the right. This one took out the left. Probably this could be a fake out or what have you. People knowing fully well that you're going to put your stop loss somewhere around here. So they come in and take out your stop, So, but this is the normal one. So how do you trade this? Real simple. Very, very simple. You wait, because when you come into the market, this is probably if you come in and this is what you're seeing, this is what you're seeing forming. Nothing is telling you is a double bottom yet. Nothing is telling you. You can't just assume that, okay, I know a double bottom is forming. It hasn't shown you anything to make you feel it's a double bottom. It could well be this, to form another move to the upside, to form another move to the downside. So never you assume, at the market that's what's going to do when you've not seen any form of confirmation. When I would begin to say, okay, maybe a double bottom is forming. I will begin to say that if I see something like this, I see a move like this, I see a completion or something like this forming, I'll begin to say maybe double bottom is forming, because I know I have a level here. I have my my shoulder, I would call it. This is where I'm looking for. So I'm not calling it the double bottom at this point, because nothing is showing me that. But when I start seeing something like this, I see a rejection Even though it doesn't get to this rejection, I see that there's a rejection somewhere. It's not getting below that first. This is what I'm seeing. Then I was okay. A double bottom may be forming. So I'm getting ready to enter the trade. And how do I enter the trade? I need to see this. I need to see this move. I need to see that move before I can take that trade. So it means even though this goes up like this, I'm not taking that trade. Why? Because it hasn't given me a confirmation. Except maybe I drove down to the 15 minutes time frame and I saw this move. If I don't see this move, even when I go down to my 15-minute time frame, this pullback, I'm not taking it because anything can happen. It could just wick like this and come back down. So I must always remember the rule, confirmation you should always get a confirmation before you take a trade. So this is what I'm waiting for. I'm waiting for this move to happen, to break out and retest that zone that it broke out from, retest that neck that it broke out from. Remember, price action, market structure, breakout and retest, support becomes resistance. Same rule applies here. Breaks out, retested. Then I'm trading it. How do I find my TP? Good question. The measurement of this place, from that place to this place to the bottom, is your TP. That is your TP, is a measured move. So not necessarily the length of this left hand. Sometimes in some cases when you measure it, it coincides with the length, but you're not using this as a measurement. You're using because this may be smaller, sometimes may be longer. So you're using the length of the neck or the head to the bottom of that double bottom. The same thing applies to the double top as well. So now I measure this from here to here and I put it here, be my TP. And sometimes it coincides with levels, with the level that is in the market, somewhere in the market. We've seen that happen a number of times. We measure it and it just aligns perfectly in a previous level that we identified in the market. This is an example. This may be an example of a double top. Let's say, not it, because if we want to follow that principle, this is negated. Why? Because this went and this is way higher than this one. Yep. So this has probably been negated. But if you look at it, it's a winning trade because you see that move, you see that move, you see that move. See that move, and then you see that drop. So yeah, this might be considered a winning trade, but in abiding by the rules, it just broke this. Yeah? So now that you may decide by yourself that okay, I don't mind as long as I see, even though this breaks the previous high, I don't mind it as long as it still shows me a confirmation to the upside here. It breaks out, it breaks my let me see this, put this here. So let's say I was trading this. As long as I get a breakout of that neck, a retest, I'm gonna take the trade. So I'm gonna take the trade. And remember, stop loss. Yeah, that's something I didn't share. Your stop loss would normally be somewhere around here. Sometimes it's so far away. So imagine if you had the second leg longer, so it means this is where your stop loss would be. Sometimes it's okay, this is where your stop loss would be. Or you can decide where you want your stop loss to be based on how much you have in the trade. You may not necessarily you don't necessarily need to put it that high. You could just probably put it somewhere there or somewhere around here. As long as you know that, okay, you're protected. Because what happened, this came back, it jumped away from our zone, it went further than where we thought it was going to go. But at the end of the day, it still dropped. So that could be your rule. You could decide, okay, I'm still going to take, this is a weird looking double bottom. If you wanted to trade it as a double bottom, some people might also see head and shoulder here forming. Some may see this flag. That's another thing. So most of these patterns, they can be come in between themselves, form within themselves. Like look at that massive flag. See that giant drop, that pullback, and another giant drop. So those are the kind of things you would be looking for in the market. That's a double bottom, a sweet looking double bottom, but you know what the rule is? Double bottoms must always come like this, and then you see that double bottom and then that move. This looks like a double bottom, but it didn't obey the rule. It came from bottom, although it created double bottoms and then, yeah, sure enough, went up. But then what did you notice? If I were to take this trade, it wouldn't have been a winning trade for me after a while, because I would expect this to come up, retest, and then probably give me my measured move from here to here. But did that happen? It didn't give me all my TP. Nah, it didn't at all. It didn't. Yep. So it went south. So this wasn't a valid double bottom. So, okay. I said I was just going to show two. Maybe another time I'll show more. But as we progress in the platforms, you would have, the way we create our chart, we tend to identify these moves before. Okay, that's it. That's a good one there too. Good double bottom. See that giant move from the upside. See that double bottom here forming. Sure enough, this guy is lower than this other guy. And then if I was to be conservative from my, okay, let me put this here. Put that there. Excuse me. Put that there. And then, and I measure my move. What did I first of all see? A break above, and what again? A retest. Fantastic, even on the daily time frame. Did I win this trade or not? Sure enough, I won it. Massive win. Smash TP. A few more pips on the upside. So that's an example of a sweet double bottom. Okay, so like I was saying, the way we mark our chart, we tend to identify these patterns when we see them. When we see double bottom, I know DD sees a lot of double bottoms and all of these patterns, head and shoulders on our GU pair. She's become so very good at identifying these patterns. So you will see us identify them in our charts when we mark them up sometimes. So that should help you to also trade them or mark them up yourself, to also help you seeing them clearly. So do you have any question, Dory? Any question pertaining to head and shoulders? No, sorry, double bottoms or flags?
No. Actually, it's becoming clearer and clearer. The more I see it mapped out, the more I'm getting understanding.
Yeah.
But I'm just concerned about, like the fake outs or whatever. I mean, once you have confirmation that, maybe that your trade is going a certain way, how do you know and how sure can you be that that's where it's supposed to go?
You can never be so sure.
Okay.
Right. You can never be so sure that it's going to get there. But what you do, you have your stop loss is your angel. It's supposed to protect you just in case. But again, doesn't mean you have to run out. The reason why that's why you have your stop loss in place.
Okay.
Don't trust that analysis is going to go your way. Otherwise, you're going to put a standard loss size into it. Just know that you're going to mark up your charts and then you're going to follow your plan, to the letter. You're not going to over leverage. You're not going to get emotional. Once you marked it up and it says the head and shoulder and you've identified where your target is going to be, set your targets in place. Set your stop loss in place. If the trade hasn't come back to hit your stop loss, you're still good. Even if it goes back 99%, back to where your entry is. Because 99% of the time it starts to that level, and then you said, "Oh, it's gonna hit my stop loss." I get out, and then what happened? It doesn't get there, and then it drops 100 pips, and you're sitting there with your hands on top of your head. I'm like regretting, why did I get out? Why didn't I stay? So you want to put your stop loss in place, put your target in place, and let the trade run its course. Don't say that I know this is gonna work out, because that's going to tell you, okay, because I know it's going to work, I'm going to drop a standard, 5 standard lot sizes into it, and I'm going to wait for you to click, So because what happens is this, there are elements in the market that affect the market. Your own human error as well is also a factor. So people, market movers, market makers, the big money, smart money, and all of those other elements, news, they affect the markets. So there's no way to be sure that our trade is going to always win. We identify, we look at the market, we make our analysis, we say it's going to be a buy, it's going to get to that level, it may fall short, it may not get to that level before dropping. So that's why we are constantly moving our stop loss into profit as the market goes on. As long as it's going to the right direction, we're moving it. If we have a place to put a pullback to put more positions, we do that, we increase our winning. So as much as possible, we try to avoid losing a trade. That's why we use the strategies we use.
Thank you.
Yeah. So any other question at all? Okay. So what I'm going to do, we have, I think we have news, some CAD news, USD news coming up later. Those will really probably just move the markets a bit. I marked up some charts. They haven't really, except for a few ones here and there, that moved, but we've not really seen major moves in the market. But I hope with the news we'll see some good moves. But I'll keep sending out charts. What I want you to do for me is to go on the different charts. You can pick 2 or 3 that you really like to trade and see if you can identify these patterns in the market. You have this document. I don't really trade these things. I don't really trade these ones. What I'm really always looking for is something like this pullbacks. Sometimes I do this cup and handle. We call it cup of cocoa now. These are the ones I really look for. Head and shoulders, double tops, double bottom. There's 3 put up. I don't really look at those ones as well. They are there, double bottoms and double tops. So see if you can identify them. Follow this, use these charts. There's another one on there as well that you can also use. Okay, this one as well is another one that you can also look at as well.
Yeah.
And then use your trend lines to identify them, to map them out, and then send them on the platforms so we can all look at it.
All right. Sure.
Okay. So you see, the more you practice, the more it becomes part of you. Okay. All right then. So it was nice having you guys on call. I would speak to you guys later. Have a fantastic night. Thank you very much, TD.
Thank you.
We'll see you soon. Take care.
Thank you.
Bye-bye.
Bye-bye.
Bye.